Hello everyone, and welcome back to Virginia International University's Accounting 201 Principles of Financial Accounting course. This session will cover the measurement and reporting principles for long-term tangible fixed assets, also known as plant, assets, or property and equipment, as well as intangible assets. Businesses use several types of long-lived assets, as shown in this table. The table also shows the expense that applies to each asset. For example, buildings, airplane, and equipment depreciate, natural resources deplete, and intangible assets are amortized. So we talk about the using up of the useful life or units of measure of these assets. We talk in terms of depreciation, depletion, and amortization. So plant assets are long-lived assets that are tangible, meaning that they have physical substance, for instance, land, building, and equipment. The expense associated with plant assets is called depreciation. Of the plant assets, land is unique. Land, as you may recall from previous sessions, is not expensed through depreciation over time because its usefulness does not decrease. Most companies report plant assets as property, plant, and equipment on the balance sheet. Natural resources such as oil and gas reserves, coal mines, or stands of timber are accounted for as long-term assets when they are purchased or developed. As the natural resource is extracted, its cost is transferred to inventory. Later, as the inventory is sold, its cost is transferred to cost of goods sold. Intangible assets are useful because of the special rights they carry. They have no physical form. Patents, copyrights, and trademarks are intangible assets, as is goodwill. Accounting for intangibles is similar to accounting for plant assets. So let's talk now about how to measure and account for the cost of plant assets. Here's the basic working rule for determining the cost of an asset. The cost of any asset is the sum of all the costs incurred to bring the asset to its intended use. The cost of a plant assets include purchase price plus any taxes, commissions, and other amounts paid to make the asset ready for use. The cost of land includes its purchase price, cash plus any note payable given, the brokerage commission, survey fees, legal fees, and any back property taxes that the purchaser pays. Land costs may also include expenditures for grading and clearing the land and for removing unwanted building. Remember, the cost of land does not include the cost of fencing, paving, security systems, and lighting. These are separate plant assets called land improvements, and they are subject to depreciation. The cost of constructing a building includes architectural fees, building permits, contractors' changes, and payments for material, labor, and overhead. If the company constructs its own building, the cost will also include the cost of interest on money borrowed to finance the construction. When an existing building, whether it's old or new, is purchased, its cost includes the purchase price, brokerage commission, sales and other taxes paid, and all expenditures to repair and renovate the building for its intended purpose. The cost of equipment includes its purchase price as well, less any discounts, plus transportation from the seller, insurance while in transit, sales and other taxes, purchase commission, installation costs, and any expenditures to test the asset before it's placed in service. The equipment cost will also include the cost of any special platforms. Then, after the asset is up and running, insurance, taxes, and maintenance costs are recorded as expenses, not as part of the asset's cost. The cost to pave a parking lot is recorded in a separate account entitled Land Improvements. This account includes costs for other such items as driveways, signs, fences, and sprinkler systems. Although these assets are located on the land, they are subject to decay, and their costs should therefore be depreciated. Companies often lease equipment or property and customize these assets for their special needs. Such improvements or customization to leased assets are capitalized. The cost of leasehold improvements should be depreciated over the term of the lease. Most companies call the depreciation on leasehold improvements amortization, which is similar in concept to depreciation. Businesses also often purchase several assets as a group or a basket for a single lump sum amount. For example, a business may pay one price for land and a building. The company must identify the cost of each asset. The total cost is divided among the assets according to their relative sales or market values. This technique is called the relative sales value method. In the above table, assume a company purchased land and building for the combined price of $450,000. The values of the individual assets are shown in the market value column. This column is total. Then the market value of each asset is divided by the total market to determine a percentage. This percentage is then multiplied by the cost. The end result is that the land is allocated $90,000 or 20% of the cost, and buildings is allocated $360,000 or 80% of the cost. The next objective that we want to talk about is how to distinguish a capital expenditure from an immediate expense. When a company spends money on a plant asset, it must decide whether to record an asset or an expense. Expenditures that increase the asset's capacity to produce or extend its useful life are called capital expenditures. For example, the cost of a major overhaul that extends the useful life of a truck is a capital expenditure. Capital expenditures are said to be capitalized, which means the cost is added to an asset account and not expensed immediately. Costs that do not extend the asset's capacity or its useful life, but merely maintain the asset or restore it to working order, are recorded as expenses. For example, repair expense is reported on the income statement and matched against revenue. The costs of repainting a delivery truck, repairing a dented fender, and replacing tires are also expensed immediately. These do not increase the useful life of the asset. The distinction between a capital expenditure and an expense requires judgment. Does the cost extend the asset's usefulness or its useful life? If so, record it as an asset. If the cost merely repairs the asset, keeps it in a normal operating condition, or returns it to its prior condition, then you record it as an expense. Most companies expense all small costs, say below $1,000. For higher costs, they follow the rule we just discussed. Capitalize assets that extend the asset's usefulness or its useful life, and expense all other costs. A conservative policy is one that avoids overstating assets and profits. And so next we want to talk about how to measure and record depreciation on plant assets. Plant assets wear out, they grow obsolete, and they lose value over time. To account for this process, we allocate a plant asset's cost to expense over its life, a process called depreciation. The depreciation process matches the asset's expense against revenue to measure income, as the matching principle directs. Recall that depreciation expense, not accumulated depreciation, is recorded on the income statement. Accumulated depreciation is recorded on the balance sheet. Only land has an unlimited life and is not depreciated for accounting purposes. For most plant assets, depreciation is caused by physical wear and tear. For example, physical deterioration takes its toll on the usefulness of furniture, equipment, delivery trucks, and buildings, or obsolescence. Computer and other electronic equipment may become obsolete before they deteriorate. An asset is obsolete when another asset can do the job more efficiently. An asset's useful life may be shorter than its physical life. Companies may depreciate their computers over a short period of time, perhaps 4 years, even though the computers will remain in working condition much longer. Depreciation is not a process of valuation. Businesses do not record their depreciation based on changes in the market value of their plant assets. Instead, businesses allocate the asset's cost to the period of its useful life. Depreciation does not mean setting aside cash to replace assets as they wear out. Any cash fund is entirely separate from depreciation. To measure depreciation for a plant asset, we must know 3 things about the asset: its original cost, its estimated useful life, and its estimated residual value. We have discussed cost, which is a known amount. The other 2 factors must be estimated. Estimated useful life is the length of service expected from the asset. Estimated or useful life may be expressed in years, units of output, miles, or some other measure. For example, the useful life of a building is stated in years. The useful life of a delivery truck may be expressed as the number of miles the vehicle is expected to travel. Companies base estimate on their experience and trade publications. Estimated residual value, also called scrap value or salvage value, is the expected cash value of an asset at the end of its useful life. For example, a company may believe that a machine will be useful for 7 years. The amount the company believes it can get for the machine at the end of 7 years is the estimated residual value. In computing depreciation, the estimated residual value is not depreciated because the company expects to receive this amount from selling the asset. If there's no expected residual value, then the full cost of the asset is depreciated. There are three main depreciation methods: straight line, units of production, and double declining balance, which is an accelerated depreciation method. These methods allocate different amounts of depreciation to each period. However, they all result in the same total amount of depreciation over the life of the asset, which is the asset's depreciable cost. Using the straight line method, an equal amount of depreciation is assigned to each year or period of asset use. Depreciable cost is divided by useful life in years to determine the annual depreciation expense. As an asset is used in operations, accumulated depreciation, reported on the balance sheet, increases. The book value of the asset decreases. An asset's final book value is its residual value. At the end of its useful life, the asset is said to be fully depreciated. In the units of production method, a fixed amount of depreciation is assigned to each unit of output or service produced by the asset. Depreciable cost is divided by useful life in units of activity or production to determine this amount. This per unit depreciation expense is then multiplied by the number of units of activity or units produced each period to compute depreciation. The amount of units of production depreciation varies with the number of units the asset produces. An accelerated depreciation method writes off a larger amount of the asset's cost near the start of its useful life than the straight line method does. Double declining balance is the main acceleration depreciation method. Double declining balance depreciation computes annual depreciation by multiplying the asset's declining book value by a constant percentage, which is 2 times the straight line depreciation method. Double declining balance amounts are computed as follows. So first we compute the straight line depreciation rate per year. A 5-year truck has a straight line depreciation rate of 1/5 or 20%. A 10-year asset has a straight line rate of 1/10 or 10%, and so on. Second, we multiply this straight line rate by 2 to compute the double declining balance rate. For a 5-year asset, the double declining balance rate is 40%, or 20% times 2. A 10-year asset has a double declining balance rate of 20%, or 10% times 2. The formula 2 over life in years shown on the slide is a shortcut way of combining these steps. Third, we multiply the double declining balance rate by the period's beginning book balance value, cost less cumulative depreciation. In the first year of the asset's life, the book value is equal to the cost. Under this double declining balance method, ignore the residual value of the asset in computing depreciation except during the last year. Then finally, we determine the final year's depreciation amount. That is the amount needed to reduce asset book value to its residual value. The residual value should not be depreciated, but should remain on the books until the asset is disposed of. So the double declining balance method differs from the other methods in 2 ways. First, residual value is ignored initially. First year depreciation is computed on the asset's full cost. And then depreciation expense in the final year is the plug amount needed to reduce the asset's book value to the residual amount. Generally accepted accounting principles say to match an asset's depreciation against the revenue the asset produces. For a plant asset that generates revenue evenly over time, the straight line method best meets the matching principle. The units of production method, though, best fits those assets that wear out because of physical use rather than obsolescence. And the accelerated method, or the double declining balance method we just talked about, applies best to assets that generate more revenue earlier in their useful lives and less in their later years. This graph shows the different patterns of the 3 depreciation methods. The amounts are based on the following data. A cost of an asset is $50,000, the useful life equals 5 years, and a residual value of 0. The straight line, which is the blue line, produces a constant amount of $10,000 per year in depreciation. The units of production, or the green line, produces a varying amount each year based on the activity. And then finally, the double declining balance method, or the purple line, starts out as the largest amount of expense but decreases each year until the last year. This is because the final year is a plug amount needed to fully depreciate the asset. So visually here we can see very clearly the differences between the different depreciation methods. This chart shows the percentage of companies that use each depreciation method from a survey of 600 companies by the AICPA. For reporting in financial statements, straight line depreciation is most popular. However, accelerated depreciation is most popular for income tax purposes. So exercise 7-19A. Ralph's Pizza bought a used Toyota delivery van on January 2nd, 2012 for $18,600. The van was expected to remain in service for 4 years or 35,000 miles. At the end of its useful life, Ralph's officials estimated that the van's residual value would be $2,500. The van traveled 13,500 miles in the first year, 12,000 miles in the second year, and 3,500 miles in the third year, and 6,000 miles in the fourth year. Prepare a schedule of depreciation expense per year for the van under the 3 depreciation methods discussed in the chapter. For units of production and double declining balance, round to the nearest 2 decimals after each step of the calculation. And so to compute the units of production, the same numerator for straight line is used. However, it is divided by the useful life expressed in units. Since this is a vehicle, miles are used. A depreciation per mile is calculated. The depreciation per mile is multiplied by the miles driven each year by the van. The double declining balance does not use the depreciable cost in its computations. First, the double declining balance rate is determined by dividing 2 by the life of the van. This results in a double declining balance rate of 50%. For the first year, the book value is the same as the cost of the van. It is multiplied by 50% to determine depreciation. The ending book value of year 1 becomes the beginning book value of year 2. The pattern continues. What is unique about this exercise is that in the third year, the book value is less than residual. We must back up and recompute year 3 so this doesn't happen. We have year 3 ending book value equal residual and then back into depreciation expense. So even though the van was assigned a 4-year life, it became fully depreciated in year 3. Plant assets are complex because they have long lives, because depreciation affects income taxes, and because companies may have gains or losses when they sell plant assets, and finally because international accounting changes in the future may affect the recognition as well as the carrying value of assets. Most companies use straight-line depreciation for reporting to stockholders and creditors on their financial statements. But for their income taxes, they also keep a separate set of depreciation records. For tax purposes, many companies use an accelerated depreciation method. This is legal, it's ethical, and it's honest. U.S. tax law permits it. Suppose you're a business manager and the IRS allows an accelerated depreciation method. Why do managers prefer accelerated over straight-line depreciation for income taxes? Accelerated depreciation provides the fastest tax deduction, thus decreasing immediate tax payments. The company can then reinvest these tax savings back into the business. Companies purchase plant assets whenever they need them, not just at the beginning of the year. Therefore, the companies must compute depreciation for partial years. First, compute depreciation for a full year. Second, multiply full year depreciation by the fraction of the year the company held the asset. After an asset is in use, managers may change its useful life on the basis of experience and new information. This is called a change in accounting estimate. Depreciation is revised and shown as in the formula. So this concludes part 1 of Chapter 7 presentation. We'll move on to part 2 in our next presentation.